A very good evening and a warm welcome to Personal Finance. I'm Kukuletu Tele. Now, I'll be sitting down with the movers and shakers in the financial services space to help you make sense of your finances. While 2015 may not be a happy year for those who overservice their Christmas stocking via debt, Ian Wason, Chief Executive of DebtBusters, and David Kop, Head of Advocacy and Consumer Affairs at the Financial Planning Institute, join us now for some debt damage control. Gentlemen, thank you so much for joining us. Maybe, David, if we can pick up with you here in studio, debt. The good, the bad, and the ugly. Some consumers have it in their minds that it's not that bad as long as you can manage it correctly. But unfortunately, we fall into that trap where managing it correctly is completely out of our hands.
Yeah, I think the problem is as soon as you accept that debt is a tool that can be used whenever and wherever, you are going to get yourself into trouble. Let's start with bad debt. So I often use the example when I talk. It's something which you'll be paying off long after you've enjoyed the benefits. And I use the example of buying food on debt. So you've consumed the food, it's gone through the whole process, you've enjoyed the benefits. 24 hours later, you no longer get the benefits, yet 6 months, 12 months later, you're still paying for that. Good debt, I don't know if you can term it good debt, maybe necessary debt. Things like buying a house, which one day eventually when you unsell it or retire and buy a smaller house, maybe you can make some profit or money out of it. It would enable you to get onto the property market quicker. So maybe a home loan can be seen as necessary debt.
So not so much good, but maybe necessary.
Maybe necessary,
exactly.
To get onto the property market. Yeah.
Exactly. Ian, maybe this is where you can also come in to give us your perspective. It does seem as though some consumers often find it necessary to also call on debt or have debt because they often want to have some kind of solid credit record where financial institutions can observe their payment patterns and maybe base their future credit lending or loan advances to that consumer based on that history. But do consumers also get it wrong at the end of the day by indulging in the wrong type of debt?
Yeah, absolutely. In fact, hearing David talk about good debt and bad debt, unfortunately, what we've seen with our aggregate book of debt from our consumers is that it's switched from 4 years ago where the majority was home loans, so good debt. Now the vast majority of debt in our consumers' portfolio of debt is bad debt, is unsecured debt. And the trouble with unsecured debt is it's generally of a shorter term nature, and the interest rates and fees are obviously far higher than what it would be on a home loan. The problem is that once consumers start using these personal loans or bad debt, and they start buying things on credit cards, and their overdrafts and using these funds to buy food, is that they find that at the end of the month, the end of the next month, they're even shorter in terms of their cash flow, so they have to go out and borrow more money. And generally, the more money you borrow, the more expensive it gets. To give you an idea of our average consumer at DebtBusters, and we're about 20% of the debt counselling industry, so it's a pretty good sample, our average consumer is 34 years old. They earn 20,000 Rand, so middle upper income bracket, and they have 10 credit agreements. But I think the most worrying fact is when they come to us, on average, they're spending 108% of their net monthly income on debt repayments. So they've been using one debt to pay off another debt and are rolling it, borrowing from Peter to pay Paul.
Sheesh, which is definitely a solution that doesn't really work well. But keeping with those statistics, Ian, I'm sure at this time of the year you often see quite a significant peak in individuals who seek some kind of solace or some kind of advice as to how to deal with their debt.
Yeah, this is a busy time for us. Obviously, everyone goes on holiday and enjoys the festive season and generally probably spends a little more than they would do otherwise. The other factor is that people are generally paid early in December. So a lot of consumers are paid around the middle of December, and of course they're not getting their next paycheck till the end of January. So they've got this horrible sort of 6-week period where they've got to rely on 1 month's salary. And hence why we see a huge increase in inquiries in January. I mean, I'm afraid even this year we got over 50 inquiries on Christmas Day, which is slightly depressing. You think you've unwrapped your presents and eaten your Christmas turkey, and then you nip off to your study to go and call a debt counsellor and find out how you can change your life in 2015.
Exactly. To come back to you, David, clearly that's a grave concern. Christmas Day, we heard the story there coming through from Ian, but from your perspective, are professionals in the industry also finding it difficult to liaise with their clients when it comes to the usual December period where it's the same story year in, year out, have lots of money in December and you are reeling in debt in Jan?
I think one of the most important things that we look at from a financial planning viewpoint, and one of the first steps of avoiding this is a simple thing called a budget. If you work to a budget, if you manage your budget and your spending plan properly, you wouldn't get into that situation. Ian referred to you need to live 6 weeks on one paycheck. But no, because normally you live 1 month to 1 month. So why must it be 6 months? Don't spend your December money until January when you would normally spend it. The other step is looking at your goals and your savings goals. So if you sit down with a certified financial planner professional, the first thing they would do with you is look at your budget, and then they'd ask you, what are your goals? What do you want to achieve? And by setting your goals, you know you've got something to work towards. So if I want to go on holiday every December, I know during the year, this is the amount that I need to put away in order to achieve that goal. Those are the two important tips I can say to avoid getting into these situations.
For the layman in the street, though, they might be finding it difficult to balance between tackling this debt alone or, as you say, speaking to a certified financial planner. Is there a plan for you to tackle debt alone if that's your only option?
If that's the only option, yes, go for it. Tackle it alone. We do have resources on our website which members can go to. You can go and Excel, build yourself an Excel spreadsheet to try and look at that. I think the important thing is if you are looking at paying down your debt, one of the things we recommend is look at your smallest debt first and start paying that off. Once you've paid off that smallest debt, take the money that you're paying into that and pay it into your next biggest debt. That gives you several wins along the way. So one of the big problems is if you're paying off your debts and you don't see anything happening, you get despondent, you get depressed, and then maybe you go back and buy some food or go on holiday because you feel you deserve it. But by paying your smallest debt off first, it's a great experience to go into that debt provider and say, look, I've paid you off, please cancel my account. And you get that motivation to continue paying off your debt. But if you are struggling to do it alone and you can't find yourself that you can be responsible for yourself, seek out the help of a professional. The financial planner would come in where you're still managing, where you find yourself that you're not managing to meet your monthly repayments. That's when you would go to a debt counselor, because you're already too far down the road maybe for a financial planner to help you out. If, like Ian said, you're spending 108% of your income, it's going to be difficult to put a budget together at that stage. And that's where debt counselling would come in and you seek the help of a debt counsellor.
Exactly. Ian, from your perspective, the kind of strategy that at DebtBusters that you usually deploy to assist some of your clients in reaching their financial fitness levels, if you can walk us through it. Is it again, as David had mentioned, that you pay off the smallest debt first?
Absolutely. Look, I think, first of all, if every single school leaver or university graduate sat down with David for 5 minutes before they started the work and it started in the working world, there wouldn't be a place for debt counsellors in this country. But unfortunately, the kind of horse has already bolted. You've seen unsecured debt shoot up from 40 billion to 176 billion in the last few years. 13 million of South Africa's 21 million credit active consumers are in arrears. So, it's really left, when people come to us, as David says, it's too late for financial planning. And although it's very easy to get into debt by yourself, it's very difficult to get out of it by yourself once it's reached those extremes. What we do is obviously debt counselling is a 5-year process generally, where we put the clients on a payment plan. We have agreements with the banks where we can slash their interest rates to 0 if necessary. And the clients make 1 monthly payment to get them out of debt. While we're taking them through that debt counselling process, we also focus on the education and a lot of the aspects David was talking about from financial planning point of view, in terms of managing your budget, where to save, how to save, where you can cut the costs in your living expenses, looking at things like your insurance costs. Can you get a cheaper quote on your car insurance or your household insurance? And then obviously as we get them towards financial health, then we can start talking to them about getting to financial wealth, and looking at, are they correctly covered for things like life insurance, their family correctly covered, and looking at their retirement annuities and everything like that. I mean, ideally, if we do our job properly, we will never see our clients again after they've come out of debt counselling, because they'll have a proper plan of which to manage their finances going forward.
Just on that, the success rate, is that also closely correlated to the level of financial literacy that so often a lot of your clients might not have enough of?
Absolutely. 45% of our client base were born in the 1980s. That's the unfortunate thing, is our client base seems to be getting younger and more indebted every single year. So financial literacy is a huge problem, and as we've just seen from the latest matric results, the kids coming out of the education system at the moment aren't exactly financially literate from doing their maths matric papers, let alone how to balance their budget, what a credit card is, what a home loan is, and really the beauty of compound interest, but also the dangers of it if it goes the other way and you get yourself into debt. So far more needs to be done in terms of financial education. It's a question of whose responsibility that is.
Just on that, is there also an illusion, David, that maybe this world of debt is only for a certain LSM group? Or are we disillusioned? Do the rich also have financial problems in other ways?
I think everyone has financial problems, and I think it's not limited to the poor. Rich people also get into debt. It's about, and Ian mentioned, it's about financial literacy. I've seen neurosurgeons and guys who are high up in there who don't know how to work with money. They're brilliant in their field, but they don't know how to work with money. And whose responsibility is it for financial literacy? And ultimately, it is your responsibility. It's a personal responsibility. I've started with my 5-year-old already teaching her about money.
Does she know what interest rates are?
We haven't got there quite yet. We're still working with a piggy bank system. But I'm teaching her to save and put something away. Just this weekend, we went to the toy shop and she saw this dolphin toy which was selling for 700 Rand. She only had 400 Rand. So she had to make a choice there. Does she go ahead and spend that, or does she go away and start saving? So she bought something. But the rest of the money she's put away so she can ultimately get this dolphin toy that she wants. And that's the important thing. Teach her from an early age that you've got to save rather than getting a loan to get what you want.
Exactly. So it starts young, and it almost sounds as though it's everyone's responsibility at the end of the day.
Yeah, it is. I think, again, our school system can do a lot more. As the FBI, we've got our own financial literacy program that we roll out to the consumers. Called the FBI My Money 123. But I think schools also need to take some responsibility. If we can teach kids in high school as a starting point how to work with money, give them those life skills, so when they do go out into the working world, they've got a good basis and foundation to start with from paycheck one.
Exactly. Gentlemen, thank you so much for joining us today. It does seem as though interesting insights for the viewers to take away. But that's it for Personal Finance this evening. Thank you to DebtBusters Chief Executive Ian Wason and David Kop from the Financial Planning Institute. Remember that we'd love to hear from you, so you can tweet any of your comments and feedback to @CNBC Africa using the hashtag Finance410, or even to myself @Gukumfupi on Twitter. For myself and the team, it's good night for now.